Now, as we pivot to Europe, we want to look at some of the key pieces of where things are. So when we look at the survey expectations, the ZEW is expected to be at 38. Previously, it was 38.7, came in at 23.6. Industrial production was expected to be down 1.5%. Was down 2%. So there's still, again, there's some of those slowdowns that are there, but then when you look at the ECB, they've kept things the same. I should say they were right in line with expectations. Previously they were at 2%. On the main refinancing rate, they were expected to raise by 50 basis points, came in at 2.5, right in line. Marginal lending facility was expected to be up 50 basis points as well, came in at 2.75%, and same with the deposit rate of 2%. So again, still a tightening metric. They're still going up, and just based on where inflation is, where the ECB is, they have no choice. And that's what we've been saying from the beginning, is they're going to be forced into action, and that's what we've seen right here. Germany, CPI was expected to be negative 0.5, was negative 0.5. Year over year, expected at 10%, came in right in line. ZEW survey expectations, 23.3. Current situation worsening, expected to be at 57, came in at 61.4. And then wholesale price index was down to negative 0.9. A price index year over year still at 14.9%. So some slowdown in some of this, but the slowdown is also coming from the lack of demand, which are some of the things that we're going to look at over the next few slides. So German manufacturing orders have slowed down. You can still see that they're still above 100, so still moving at a steady pace, but industrial production has slowed. So now you're below 100, you're in a contractionary standpoint, you're slowing things down, but again, orders are still trickling in. It's just there's a lot of inventory. There's other issues in terms of internal demand. So even though as the orders come in, you don't need the same production because local demand is different than exporting demand, which are some of the different pivot points. German construction PMI came in at 41.5. So again, it's back to the extremes, still a lot of contraction. German construction housing, deeply negative. Again, that is a bigger problem when you look at some of the leading indicators that come from the housing segment. Then when we look at expected change in terms of the basis points, cumulative versus incremental, there's an expectation that they start to slow down those raises in February and March. Given where things are, I think it's a bit unlikely that they slow in Feb. I do think there's a chance that they slow in March, especially because the economic surprise index is going back up, which means that they're not maintaining some of the estimates. They're getting slightly better, which is a part of the reason why we're getting some of those expected adjustments. But we still haven't seen retail data. We still haven't seen consumer data, and we know that exports have slowed. So then when you look at some of the issues that remain a problem, well, the French nuclear power is still missing in action. So when you look at it of where they averaged between 17 and 21, and then when you look at where they are, they've started to come back, but are still very low based on where they should be. Then when you look at German industries' change in approach to gas crisis, gas savings without an impact on production was minimal, or at least 75% said minimal during the past 6 months. But that changes as you go forward. They're like, look, we could make do with what we had previously, but going forward, we can't maintain production levels. We're going to have to cut. So again, that becomes a much bigger issue for the economy because under the current backdrop of the natural gas situation, the Russian situation, the availability of diesel, of natural gas, that's going to, again, limit the amount of economic growth that they can muster up. With manufacturing forms a larger share of the economy in Germany than in most industrial countries, which is why that number for industrial change is a big issue when you consider German growth and why we think that the recession in Germany and Europe could be much steeper than expected. German manufacturers' differing views on the gas crisis. It's, again, something similar. Can save gas, but by cutting back production is fairly sizable. Chemicals, plastics, food and feed. All of those key pieces, when you look at just activities, that's a big problem. Automobiles, obviously, is a kind of a mixed bag, but glass, ceramics, chemicals, metals, plastics, rubber, food, feed, Those are important pieces of the German output, which is why that is such a big problem. So then when you look at German mortgage lending, a record decline in October. The sharp rise in mortgage interest rates since the beginning of the year is increasingly reflected in the demand for mortgages, clearly evident from the latest data from the ECB. While the volume of new financing concluded was still almost 20% up on the previous year in May, it had already turned significantly negative in June. And that's going to be a bigger problem as we go forward based on what we showed you with PMI construction, some of these other movements. In absolute terms, the volume of new mortgage lending fell by a further 1.2 billion in October. And again, that's going to weigh on underlying economic progress. Wage growth is also driving service inflation, which is, again, as we've been talking about, wages get pushed through to the end user. You're going to increase prices. You're going to see PPI go up. That is going to be a driving force, and that's going to be a big overhang when you look at some of those different pieces. And then wages resumed the upward trend, which again is going to support CPI, create something similar that we're talked about in the US, not a deflation, but more of a disinflation leading to that stagflation that we've highlighted. Eurozone service demand and price expectations. So price expectations moved up as demand starts to roll over. And again, service rolling over, and this is over the next 3 months. So as we look forward, you still have inflationary pressures, but demand going down. That's a stagflationary backdrop with a lot of pressure on the economy. Financial conditions down, bank-based financial conditions tightening, market-based financial conditions. Again, all of these things continue as they try to pull liquidity from the system, as they try to bring things under control, all under the fact or while their local economy continues to worsen. ZEW German assessment survey was for 57, came in at 61.4. You can see just how low that is. Expectations for economic growth still negative, but not as negative. And that's where we see things, again, just continuing to bump along this negative bottom. Industrial production in Italy slowed, still expanding, but slowing. Eurozone quarterly inventory change surged, which again is a problem because as you have this inventory build, well, you don't need industrial production to the same level. That can then slow. And those are some of the problems that we're seeing when you look at these inventories and why we see production falling, why we see the local consumer not purchasing and buying because of these inventory shifts. Household new deposits and new loans. Household new deposits going up, household new loans coming down. Again, people don't want to spend. So then when you look at the labor side, as we start to pivot into China, because I think it's an important piece in terms of where China is, where things are, because household new deposits, household new loans, Chinese slowdowns, that's a big issue when you start looking at where things are between Europe and China, because China has become a big importer of European goods. And based on this, there's no real demand for it. There's a slowdown. And then when you look at the labor situation and the GDP composition, it's only getting worse. And that's going to slow down GDP growth. And that's going to, again, whittle down buying, which is going to impact Europe directly. So that's what we have for you on Europe today. Next week, in the next segment, we're going to go deeper into China and some of the issues that they are facing on multiple levels as their economic data has worsened.